January 30th, 2026. The U.S. Treasury dropped a sanctions update that looks technical, but the mechanism is modern and market relevant. Here's the verified anchor. Treasury's Office of Foreign Assets Control announced fresh Iran-related sanctions. Reuters reported the move the same day. The detail is the tell. By the end, you'll know what changed. You'll know why payment rails matter as much as barrels. And you'll have 3 clean signals to check this week. Start with one anchor example. Picture a mid-size fuel buyer in Asia, a private refinery with a trading desk. They're not forecasting oil for fun. They're trying to settle a cargo safely. In the old model, sanctions meant supply risk. You asked, will there be fewer barrels? In the new model, sanctions can hit the money pipe, settlement, insurance, and financing. That's where stress can spread. Receipt moment. Put Treasury's January 30th, 2026 press release on screen. Show the dated announcement and the name designations. That date stamp anchors the chain. Now the mechanism, step by step. First, it's legal. OFAC designations draw a compliance boundary. Banks, shippers, insurers, brokers, and exchanges must respect it. Second, it's operational. Real trade needs paperwork and settlement. Invoices, payments, letters of credit, and insurance. If one link turns non-compliant, routes bend. Third, it's economic. When settlement gets harder, the cost to clear rises. Not just the cost of oil, the cost of moving, insuring, and financing it. Go back to our refinery. A cargo is scheduled for next week. The seller is willing. The ship is available. The question is whether the payment path clears. If the payment touches a flagged party, the deal can freeze. If insurers see a compliance gray zone, premiums jump. If banks refuse the wire, buyers hunt for workarounds. That hunt is where markets feel it. This stops being only Iran news. It becomes a funding and risk premium story. Cross-asset, the channels are straightforward, commodities. Options often react before spot. Even if physical supply is unchanged today, tail risk can reprice. FX, settlement friction can lift demand for dollars as a funding bridge. You can get dollar strength without a clean macro story. Credit, higher counterparty caution can widen spreads, especially for shipping, energy services, and high beta trade names. Equities, you can see rotation and volatility, but the driver is the cost and certainty of settlement. Here's the contrast to hold. This is not only about stopping barrels, it is about raising the cost to clear. That cost shows up as discounts, rerouting, and insurance terms. It shows up as payment delays and tighter credit lines. Even compliant firms pull back when rules feel uncertain. That's why the next 24 to 72 hours matter. The first pressure point is the compliance response. Does the market treat this as contained? Or as a widening perimeter? Our refinery has deadlines. A berth has a window. A payment has a settlement date. A refinery has to run. So the desk builds a bigger cushion. They demand a bigger discount. Or they avoid the route entirely. Scale that behavior, and you get a new premium layer. Not because demand boomed, because friction increased. Now climb the stakes ladder, naturally. In the next 24 to 72 hours, watch for the first who backs away move. If intermediaries pause, costs jump quickly. Over the next 2 to 6 weeks, the story moves into contracts and logistics. You'll see it in differentials, freight, and hedging demand. If this persists, the breakpoint is settlement confidence. Trade fragments and discounts become structural. That's not a prediction. It's a conditional path. It depends on enforcement intensity and counterparties' tolerance. Now bring the anchor example forward again. Our refinery's next question is not, what is Brent? It is, will my bank clear the payment? If the answer becomes maybe, behavior changes. Shorter tenors, more collateral, more avoidance of any gray zone counterparty. This is also why crypto appears in the story. Quick definition once. A payment rail is the pathway money takes to settle a trade. Banks are the classic rail. Stablecoins and crypto exchanges can be alternate rails. A common real-world response is de-risking. Compliance teams do not try to be heroic. They try to avoid ambiguous exposure, so they widen their internal red zones. That alone can reduce liquidity in certain trade channels. That is how a sanctions headline becomes a market move. Not through a single blocked payment, through thousands of counterparties acting more cautiously. For our refinery, that caution changes pricing. They may demand payment in a more conservative currency. They may ask for more documentation. They may pay higher financing costs for the same cargo. And the knock-on can be weird. Spot prices might look calm, but time spreads can shift. Options can get bid. Freight and insurance can rise before spot reacts. This is education, not financial advice. Now, if you want to connect this to the daily tape, watch a few standard dashboards. DXY for broad dollar tone. 2-year U.S. yields for funding sensitivity. CDS and credit indices for counterparty fear, and oil implied volatility for disruption pricing. None of those is perfect alone. Together, they tell you if the rail story is spreading. So, the clean question is this: is this action mostly symbolic, or is it tightening the settlement perimeter? We answer with signals, not vibes. Exactly 3, Signal 1. OFAC updates, press releases, FAQs, and licenses. Direction, broader designations raise friction, clarifications reduce it. Lag, same day to 2 days. Signal 2, oil options implied volatility. Direction, higher implied vol means higher disruption pricing. Lag, intraday. Signal 3, freight and insurance cost, proxies. Tanker rates and war risk premiums, plus big freight indices. Direction, costs up while spot is flat means friction is winning. Lag, days to a couple weeks. In the next chunk, we tie this to dollar liquidity and credit. We'll also map what breaks first if it escalates. Keep the frame tight. Sanctions can be an oil headline, or they can be a settlement headline. This one leans settlement. Now we connect it to dollar liquidity because trade is funded, not just shipped. Our refinery needs working capital. They borrow to buy crude. They hedge. They settle. Every step touches funding. If banks tighten compliance, 2 things happen. Payments take longer, and financing becomes more expensive. That pulls on the same lever as a rate hike, not through policy, through risk and friction. Here's the second receipt moment. Show Reuters' January 30th report. It describes the sanctions action and the stated intent. Pair that with the OFAC press release timestamp. 2 independent sources. 1 verified event. Now, model the chain as a stress test. Step 1. More counterparties get flagged or more rails get targeted. Even if your firm is clean, your counterparty's counterparty might not be. Step 2. Intermediaries reduce exposure. Banks cap lines. Insurers reprice. Brokers demand more documentation. Step 3. Trade flows slow or reroute. Not because demand collapsed, because settlement clearance takes longer. Step 4. That delay changes cash needs. Buyers hold bigger cash buffers. They shorten terms. They pay a premium for clean routes. This is where the dollar can catch a bid. Not because the U.S. economy suddenly improved, because the world needs dollars for safer settlement. This is also where FX can look weird. Oil up, but some EM FX down. Or oil flat, but regional FX volatile. That's a funding story. Back to our refinery, they have 2 choices. Choice 1, stay fully inside conservative banking channels. That reduces legal risk, but it can increase cost and delay. Choice 2, use alternate rails, including crypto-linked channels. That might reduce friction, but it can increase compliance risk, and it can raise counterparty risk. Treasury's message is simple. They are watching those alternate rails. That increases uncertainty for anyone relying on them. So, the market question becomes, does this reduce the escape valve? If it does, risk premium rises. Because there are fewer ways to clear trade quietly. Now, plug this into credit. Credit markets price default probability and liquidity. Sanctions can impact both, not just via energy prices, via cash flow disruption. Who feels it first? Trading firms with thin liquidity. Shippers with exposure to specific corridors. Insurers facing tail claims. Refiners facing payment timing risk. If financing costs rise, margins compress. If settlement delays rise, working capital needs rise. That is a cash squeeze channel. This is how a headline becomes a credit story, even without a big move in spot oil. Now, the anomaly watch. A classic mismatch is this. Spot crude looks calm, but front-month implied volatility rises. Freight costs creep higher, and credit spreads and transport tick wider. That combination says friction is building, even if the commodity chart looks boring. The second mismatch, oil inventories can draw, but prices do not move, because macro fears offset, or because the market believes supply is there, but hard to deliver. Delivery constraints can look like nothing until they look like everything. Now, let's tighten the what breaks first angle. In this story, the first break is not demand, it's settlement confidence. If counterparties fear that payment can be reversed or frozen, they demand a discount. If that discount grows, flows shift. If flows shift, regional prices diverge. That is the early warning. Price gaps and delivery premia. Our refinery revisits the anchor example again. They now ask for a wider discount on riskier cargo. They pay more for safer cargo. They might keep runs stable, but their costs rise. That is real economy spillover. Their product prices drift up, transport costs drift up, and that leaks into inflation narratives. On the rate side, it matters through break-evens and term premium. If energy risk premium rises, inflation expectations can rise. Even if growth is slowing, that's the painful mix. But we stay conditional. This only persists if enforcement stays tight, or if follow-on designations expand the perimeter. Now we map the catalyst window precisely. Next 24 hours. Watch whether OFAC issues follow-up FAQs or clarifications. Markets relax when the rules are explicit. Markets tighten when rules are vague. Next 72 hours. Watch whether major banks or insurers signal de-risking. You won't get a press conference. You'll see it in terms, spreads, and routing. Next 7 days. Watch for copycat actions or allied alignment. When more jurisdictions align, alternate routes shrink. Now, keep the signals clean. We already defined 3, but we add where to look detail to each. Signal 1, OFAC updates, where OFAC press releases and FAQs on Treasury's site. Direction, a longer designation list or broader language raises friction. Lag, immediate. Signal 2, oil options implied volatility. Where major benchmarks options chain, especially front month. Direction, implied vol rising while spot is flat, signals tail risk being priced. Lag, same day. Signal 3, freight and insurance costs, where shipping freight indices and industry reporting, plus broad indices like Drury. Direction, costs rising confirms the real-world tightening. Lag, days to weeks. Now, one more cross-asset link. If dollar funding stress actually builds, you can also see it in cross-currency basis and short-end funding spreads. That's the plumbing confirmation. I'm not adding a fourth signal. That's just context for how to interpret the 3. Now, why this is viral but still truthful. Because it upgrades the viewer's model. It moves them from sanctions divargir oil to sanctions variety settlement constraints. And it gives them an action plan, not a trade. A verification plan. 3 markers, 1 timeline, 1 mechanism chain. In the next chunk, we close the loop. We revisit the refinery one last time. We lay out the most likely resolution paths, and we end with a clean recap and the required outro. Now we finish by making the model testable. There are 2 broad resolution paths. Neither is guaranteed. Both are trackable with receipts. Path 1 is containment. Treasury designations land, but the perimeter stays narrow. Banks and insurers adjust, then normalize. Trading routes bend briefly, then settle. If that happens, you'll see it fast. OFAC clarifies scope. Oil implied fuel cools. Freight and insurance costs stop rising. Path 2 is expansion. More designations follow. Or enforcement tightens. Or allies align and shrink the alternatives. If that happens, the market won't wait for shortages. It prices friction. You'll see spreads widen before spot moves. You'll see price gaps between regions, and you'll see clean route premium in the physical market. Bring back our refinery one last time. In containment, they pay a little more for compliance. They adjust documentation. They move on. Their product pricing stays mostly stable. In expansion, their world changes. They shorten contract terms. They pay higher insurance and financing costs. They demand bigger discounts on risky cargo. They buy more safe cargo, even if it's pricier. That is the real economy spillover. Not a dramatic shortage, a quiet increase in friction. That friction matters because it stacks. Freight plus insurance plus financing. Each is small. Together, they reshape delivered prices. Now, zoom out to the big cross-asset picture, commodities. Oil can trade with a higher tail premium, even if inventories look fine, because the question becomes deliverability, not existence. FX. A settlement fear regime can support the dollar, even if macro data is mixed, because the market wants the safest clearing path. Credit. Counterparty caution can widen spreads in the sectors closest to trade, not necessarily the whole market on day one, but it is where cracks appear first. Equities. You can get choppy risk appetite, but the driver is uncertainty in real cash flows, not just headline drama. Now, tighten the stakes ladder into plain language. Over the next 24 to 72 hours, the main risk is a confidence hit. If compliance uncertainty grows, markets price friction immediately. Over the next 2 to 6 weeks, the risk is a new pricing regime. Contracts, insurance terms, and credit lines reset. If this persists, the risk is fragmentation. The global market still trades, but through narrower pipes. That increases volatility and makes shocks sharper. Now, keep the risk framing disciplined. This does not mean prices must spike. It does not guarantee crisis. It means the distribution of outcomes widens. When the rails are under pressure, small headlines can move big prices. That's why you watch signals, not narratives. Exactly 3, same 3, no drift. Signal 1, OFAC updates and guidance. Where? Treasury's OFAC press releases and FAQs. What matters? Broader designations increase friction. Clarifications reduce it. Typical lag, same day to 2 days. Signal 2, oil options implied volatility. Where? Major benchmark options, front month and next month. What matters? Implied vol rising while spot is flat. That is tail risk being priced. Typical lag, intraday. Signal 3, freight and insurance costs. Where? Shipping indices and war risk commentary, plus major freight trackers. What matters? Higher freight and insurance confirms the real-world tightening. Typical lag, days to weeks. Now the final check. If you see Signal 1 expand, Signal 2 jump, and Signal 3 creep higher, that is the rails story spreading. If you see clarifying guidance, cooler implied vol, and stable freight, it is likely contained. 2 last receipt reminders. 1. The OFAC press release dated January 30th, 2026. 2. Reuters reporting the same day. When you build the video, show both early. That anchors the facts before interpretation. Now, close it out clean. This week's story is not just Iran. It is a lesson about modern market plumbing. A barrel can exist, a ship can be available, and the trade can still fail. Because money did not clear, that's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.